Welcome back to the podcast. Today we are still in studio in Melbourne. Jordan, how are you?
We are. Good. How are you?
Good. So today we're doing a Q&A. We have had a few questions come in recently and thought we would get into them and answer your questions. So the way that we'll do it is we'll read the name of the person that submitted the question. And there's some interesting names here, and I guess it's so that listener can determine if it's actually them. We'll read the question, how long you guys have been listening for, and then we'll dive into our response. I guess it would be worth stating that this is going to be a relatively general response because we don't have the specifics of your business. But getting into it first, the first question we have is from somebody that has said their name is Q for Cucumber. They've been listening to the podcast for between 1 to 3 years. And their question is, I'm going to start a clothing brand outside of my full-time job. Should I register for GST when my predicted revenue will be under $75,000?
No.
Why?
Simple. So you only need to register for GST when you're turning over $75,000 or more.
Regardless of your business structure set up, whether you're a sole trader, a company.
Yep. When you start a new business, if you do expect the turnover to reach $75,000 in the first year, then you should register. You have to register if you expect
even if you know that it's going to happen.
Yeah, correct.
Okay. So if, for example, this person wasn't sure if they were going to hit 75 grand in their first year, should they set it up?
No, There's no need to. But if you have like sales lined up or contracts lined up and you know you're going to hit that threshold, then the ATO wants their money. So you need to register from the get-go.
That makes sense. So Q for Cucumber, if that is you, feel free to reach out to Jordan for a little bit more information if you would like some more info. But general response there is no, don't worry about it. Question number 2 that we have is from Sean the Sheep, a relatively new listener to the podcast. And their question is, I would like to buy a business. I want to know how to determine if the business is worth the asking price. Also, what are some common things businesses do to make it look better than it actually is? And how do I not get caught out? It's a good question.
It is. There's a few things to unpack here. The first one being you want to have a look at the company's performance in the form of financial statements. So you want to look at the profit and loss statement, the balance sheet, tax returns, their tax accounts. So you'll be able to request their income tax account and their integrated client account if they are registered for GST. Now, those two accounts are essentially a running balance of when you lodge your company tax returns and when you lodge your BASs. So it has a summary on there of what the BASs are. Super important to look at, make sure the numbers make sense, what they're reporting to the tax office. You want to look closely at the net profit, look at recurring revenue, and just make sure that the asking price is justified as a multiple of whatever the earnings is. So whatever the profit is times 2 or 3, depending on what type of business it is and what industry it's in, it's usually a multiple of the profit, being EBITDA, so earnings before interest, tax, depreciation, amortization. The ATO actually has benchmarks, so industry benchmarks where in the tax returns, there's ANZIC codes. So like every business has its own specific code. And I'm pretty sure that's how they get these industry benchmarks, where they have like a average of the profit, average of turnover, average of their labor cost, all on the ATO website. So if you just Google ATO benchmarks for your specific industry that this business is in, you should be able to see what the averages are, and then you can look at the profit and make sure it all lines up. Now, I would also look at other businesses for sale in the same industry and see what their multiple is of the profit. It should be quite easy to find online, to be honest.
And do you think, obviously some of those things you've spoken about, the research, is it best to do, would it be worthwhile this person coming or going to an accountant to get this support? Yeah,
for sure. I would suggest getting a due diligence done once you're really keen on the business, because you don't want to spend money for nothing. Make sure that you're really comfortable with it and you're happy with it. Try and take the emotion out of the decision as well, because a lot of the times people can get excited and they just want to jump in full steam ahead. So I'd strongly suggest, if you are keen, to get an accountant to go in and do a due diligence and make sure all the numbers that are there are what they say they are.
Yep. And what are some of the ways that people can get caught out?
There's a few. So sometimes people can raise invoices or bump up their income to show a higher revenue, which is very dodge. People can capitalize expenses, so move expenses from the profit and loss statement to the balance sheet. So it'll show a stronger asset position. There's also deferring things as well, like if they're putting off paying someone that'll show a bigger profit, so they won't put the payables in their Xero file or their accounting file, so they can artificially inflate profit. So if they inflate profit, which means they have a 2x multiple if they do of profit being the sale price, and that multiple will be higher.
Mm. And is that something an accountant can pick up on?
Yeah, they should. They should pick it up, yeah.
Yeah.
There's a couple of other things to touch on as well. It's key customer risk, sorry. So you want to make sure that if you purchase the business, that all of the customer rapport, if it's built with the director, that they're not just going to leave if the director leaves. So it's really important to get on the front foot and see if there's one customer that makes up 90% of the revenue, that's a huge red flag. So you want to get in there and check that as well, because that's going to really impact the future stability of the business. Yeah,
absolutely. Is there something that would factor into that? Like, is goodwill a thing anymore?
Yeah, for sure. Sure. It definitely is. Again, you'd probably want to get a due diligence done with goodwill, because a lot of the times people will just put it in there because it's a buzzword and there's no real way to quantify it. Mm-hmm. So I think getting an accountant in, a lawyer, even getting an independent valuation done would really help when making that decision whether to proceed and purchase the business. Yeah.
Sounds like there's quite a few things that
there is. Like a due diligence is a very
really important.
Yeah, very important. I wouldn't suggest buying a business without it.
Mm-hmm. Mm-hmm. Okay. Well, Sean the sheep, Sean, I guess your name is. If you want more information on that, reach out to Jordan. We'll put a link in the show notes. You can have a free discovery call with him and just ask all of those questions. If there's a lot that he ran through. If there is anything else that you want to know based on what he said, and we'll dive into it a little bit more, that's an option for you too. So another question that we have here is from Luke, has been listening to the podcast for 3 years. And Luke's question is, cash is king. So I have always struggled with cash flow. Is there an easy solution for hanging on to cash? I always seem to be scraping the bottom of the barrel every month, even when I have good months.
Yeah, it's a tough one, Luke, and you're not alone, mate. A lot of people are like that. Australia's notoriously bad for paying bills on time. There's a couple of things you can do. If you're using an accounting software, make sure all of your automated invoice reminders are set up. Now, every accounting software has the ability to do this, so I'd strongly suggest doing it as a non-negotiable. They can get automated reminders 7, 14, and 21 days after the due date. And then if you still haven't been paid, I'd strongly suggest getting on the phone to them. I'd suggest having a script, like a debt collection script. So that way it's a lot easier to have those conversations because it's structured. And then if all of that fails, then you can send a letter of demand and you can go through I think it's Fair Work and whatnot, which sucks, but sometimes you've just got to do it because sometimes people don't pay you. So it's a really shit part of business, to be honest, but you need to get on top of it and you can't just put it on the back burner because, like you said, if cash flow stops, then there's no business. So it's really important to get on top of it.
Yeah, absolutely. Thanks, Trods. And then another question that we have is from Justin.
Just in case.
Just in case. We actually had a friend at school that was his nickname, was Just in Case.
Yeah.
Yeah.
Cool.
So Justin is asking, has been listening to the podcast for 1 to 3 years as well.
Good stuff.
I want to get your thoughts on how to build in some sort of subscription service into a service-based business. My business is based around veterinary labour hire, but I want to give the clinics a value-add subscription that is also a passive income from myself. As always, amazing work, guys. Keep it up. Thanks, Justin. Interesting. That's a good question. I think I'd actually be keen to get on the phone with you and just chat a little bit more about it and understand a bit more about how your business is currently set up. But absolutely, I agree. I think if you can add in a service line to your business that becomes a passive income that is a value add, I think that's the core component of your question there, making sure that it actually does add value.
It's a tricky one because there's not too much information there. I think off the top of my head, and just to rattle a few things off, if you're a labour hire business, maybe you could have an ongoing subscription to take care of the HR side of things, maybe the compliance side of things, if there are compliance. Priority placement could be a thing. I'm not too sure of any others, to be honest.
I guess the other thing maybe I would add to that could be like additional like education and resources that you could leverage. So whether there's like webinars or articles or like guides, like topics that, whether there's like new regulations that come, again, not super familiar, but whether there's like new regulations or best practices that come out, whether there's like discounts, maybe partnerships that you can set up that can be discounts to industry specific training and things that are coming up, events that are coming up. And then I think also probably like marketing could be a good like marketing support, client
Branding.
retention, branding, whether there's kind of like communication resources that you could be tapping into, that you could be providing that your team members or your customers that are on the platform could be using. And then I think probably setting it up in different tiers, I would say, is probably like the way to go and pretty standard. We spoke about kind of like app setups and those kinds of things couple of episodes ago actually, but essentially have like your basic, which maybe it's a free kind of, what did you call it? Freemium,
yeah.
Access. So, or maybe it's just kind of what the current support of the platform looks like. And then there's kind of like your next kind of standard, which could be like all of your tier 1 benefits, but then you might get, I guess, tapping into that HR component, you might get like onboarding materials for team members when you bring new people into the clinic, when you get new vets on board. You know, and then there's maybe that like premium comprehensive kind of tier where there's, you know, the education support, maybe there's social media content and resources that people could be sharing. Yeah, I think it'd be interesting to sort of build it out. I definitely think that if you can find a way to build in a value adding kind of subscription service that once it's set up, it's kind of just runs itself.
Yep.
Then that's a really great way to bring some passive income into the business. If you want, in the show notes, we will put a link, obviously, discovery call with Jordan and a discovery call with myself. They're both free. Reach out because I'd be keen to chat to you a little bit more and just see if I can provide any more support because I like the idea.
Yeah, it's cool.
Very
Different.
cool
I like
idea.
it.
Yeah. And another question that we have here is from Hugh. He's been listening to the podcast for 3 years. I make $150,000 per annum as a sole trader. Should I change this to set up to a company rather than a sole trader? Is it better for tax reasons and why?
What do you reckon, Zara?
I think you're going to say yes.
I'm going to say it depends to cover myself. So Hugh, sole trader to company, there is advantages and disadvantages. So I'm going to give you both. One of the main advantages is the capped tax rate. So generally the tax rate of a company is 25% compared to your marginal tax rate, which is all the way up to what can almost be half of your income once you factor in the Medicare levy and whatnot. It gives you the ability to use a trust as well. I don't want to dive into that. The trust gives you more flexibility on how you distribute income to your family group or bucket companies or your partner, whoever it may be. Again, high level, there's Section 100A issues there, but just keeping it very basic. Companies have limited liability, so your personal assets are generally protected if something does go wrong in the business, and you also have your own insurances in the business, so it does give you that added layer of protection. And something that is an interesting one, and people don't often think about, is just the whole professionalism component of it. Mm-hmm. So if you're a company, it gives you that bigger perception. If it is just yourself and you're starting out, generally, again, inverted commas, generally it gives that perception that you are bigger. It gives you the ability to retain profits as well. So as a sole trader, you pay your tax rate and that's it. It is what it is. Whereas if you're a company, you pay your tax rate at 25% in the current financial year, and you can retain those profits to then invest them back into the company further down the track. It's not like a sole trader where if you make $300,000 and you're taxed half, well, it's gone. So it gives you the ability to retain profit. Now, downside, it's more expensive to set up. I mean, there's accounting fees, there's setup fees. Every year you have to pay ASIC compliance fees as well, which forever go up. So it is more expensive, but if you're in it for the long run, I'd strongly suggest having it set up and making sure it's all set up properly from the start. I always say that to clients when they ring in the discovery calls. If you're in it for the long run and the goal is to grow the business, set it up properly from the start. At a minimum, have a company. If you can afford it at the time, have a trust with a corporate trustee holding the shares to the company. And yeah, that's my suggestion. Do it.
I know this is probably not a question that you can definitively answer, but you said that there are more costs involved with a company.
Yep.
And you said like accounting fees and like registration fees and those. On average, if you could average that, what would that cost be for somebody?
Yeah, it's very different. Setup costs for a company can be anywhere. You can get them set up online for peanuts, but a lot of the times people do that and they come to us to fix it.
Okay.
So I wouldn't suggest doing that. I'd strongly suggest seeing an accountant. It can range. Some people charge $1,000 up to sky's the limit. Standard company setup can be yeah, like I said, anywhere from $1,000 to $2,000, everyone charges differently.
Yep.
And the same for trusts. When you want to create a trust, it does get more expensive.
Mm-hmm.
In terms of ongoing costs, so if you're turning over $150,000, you would be registered for GST, which means you need to lodge a quarterly BAS. You need to lodge a company tax return and prepare financial statements. So anywhere from $2,000 to $4,000. Again, it just depends. You'd be able to get, you'd be able to get that for, maybe $1,000. I'm sure there's people that'll do it for peanuts. So it just depends on what you want, who you want to deal with.
And in that example of people that might do it for peanuts, like the $1,000 end rather than the $4,000 end, does that mean that they're a bad accountant?
I don't think it means they're a bad accountant. I mean, I know how long it takes us to do things, and we like to think we do them properly.
Yep.
And all of our work papers and the effort that goes into making sure that everything is correct. And I've seen it where people get charged $150 for a BAS, and it's like, well, how do you spend time to make sure that the work you're doing is correct? It just doesn't make sense. Whereas we do our checks and whatnot and make sure everything's correct. So I wouldn't suggest going for the cheapest. I don't think that's always the right thing.
Okay, cool. Thank you. Thanks, George.
No problem.
Well, Hugh, hopefully that helps. And if you do have any other questions about it, again, reach out to Jordan and his team at Grayspace, because this is their thing.
It's our thing.
It's your zone of genius. Well, if anyone else does have questions off the back of these, off any other episodes that you've listened to, there is always a link in the show notes where you can submit a question. We do go through these. We do answer them. We typically wait till we've got a couple in there. So, feel free to reach out. Anything, obviously, from finance, business, marketing, CRM, SOPs, email marketing, whatever it might be. We're here for that, and we're here to help you as much as we can. So thank you very much for your questions, and thank you for all of your advice, Jordan.
Thank you, Zara.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.